Hello, everyone, and welcome back to another episode of Let's Talk Real. I'm your host, Ismaini, and here with me is Kelly. Hi, Kelly.
Good. Hi, I was going to say good morning, but it's not morning.
It's afternoon. We are not doing it in the morning today. That is definitely a change. And sorry, guys, for the little delay, but we had a lot going on. Doing in the middle of the day definitely is not the best option. But we are here and we're going to give you some good information. You guys can listen to it live or you can listen to the recorded version. And now we're officially in all podcasts out there. So look us up. We're on your Google Podcasts, on your Apple Podcasts, on your iHeartRadio, on your Spotify, you name it, we're there. So look us up. We're so excited about that. And into today's topic, we are going to be talking about DSCR loans that are typically used for investors. It can also be used for someone looking to buy a primary residency with the intention of growing an investment as well. We'll explain that in detail. But basically, we're going to explain to you guys how that works and what it's about and why it's a great option for someone looking to invest. But before that, we're going to do the myth of the day. And Kelly's going to talk to us about this one.
So with DSCR loans, only using rental income as an approval guideline is not always the case. So with approval guidelines, there's always a lot of things that go into play with it. But even with rental income, there are different things that the underwriters want to see as far as income coming in. If they see the income coming in, it doesn't always have to be just the rental income that we see to get the approval for it.
Yeah.
So we'll elaborate a little bit more when it comes to the guidelines so that you can understand that the rental income is not the only thing that they need to look at. Different things in the market to make sure the rental income is where it needs to be. But again, there's more that goes to play with rental income versus that just being the only income.
Factor. Yeah, a lot of people that have heard of DSCR loans, they do think, if the property has good potential for income and good cash flow, that's all that needs to be. And it's not. There's a little bit of pressure on the credit worthiness of that buyer. We also have to take into account the location, the expenses that are going with the property. So it's not just the cash flow. There's other things that come into place. And Kelly's going to be answering some questions for us today and to get more in depth into it. We are not able to get too nitty-gritty with details because this type of loan does vary based on the banks. Different banks may have different guidelines and policies and stipulations, so we cannot give you exact numbers, percentages, ratios, but we can at least tell you more or less how it works, and then you can go and do your research when you're ready to apply for this type of loan.
Correct. And just to piggyback on what you just said, we have two investors that we use, and each investor is different on what their debt ratio is, what their LTV is. So they're all different, but we offer two, and they are a brokered loan. They're not something that we do under our name, under Fairway. We do it as a brokered loan, which a lot of times
that is the case, right? Yeah, because that's not a standard loan. So there are banks that don't even offer this type of option for loans. So you do have to understand that majority of the banks that do offer most likely have either an in-house broker or they may be outsourcing that loan to another broker that are affiliated with them or work together with them. But it's not going to be sourced by the actual bank you may be talking to, like Fairway or any other bank out there.
Correct.
Yeah. Alrighty, so getting into it, we're going to start with the basics. So what is DSCR? Some people may be listening to this now are like, what the heck are you guys talking about? So let us know a little bit more about it.
So DSCR stands for Debt Service Coverage Ratio. And that pretty much, to explain that in kind of in layman's terms, is we're looking at your debt to income ratio. And like I said, every different broker has a different ratio. The two that we offer are at like 100%, one or 0.75. But there's different things that go into play with that. In order to be at the 0.75, you or back end 75 ratio back end.
Yeah.
That's more Lehman's terms. You can go up to 100%, or ours is 75. And with the 75, there, the down payment is different versus going up to 1% down payment is 20% versus 25% at going at 100% on the back end.
Mm-hmm. Okay, before we get too much into that portion of the requirements, right? So just to back up a little bit, so you said what it stands for, and basically a DSCR loan is a loan that's going to help the potential investor buy a property, not based on their income and their finances, but
Correct.
the debt to income potential of a property in particular. So the bank is not looking at that borrower's bank statements or that borrower's, well, they might be looking at the bank statements, right? You can go into detail on that, but they might not be looking at that borrower's pay stubs or W-2s. They actually be looking at the property and the expenses and the potential cash flow that's going to provide, right?
Correct. And I apologize, I should have went into that first. So we want to see more or less what the income is from that property. And that's where that back end ratio comes into play.
Yeah.
Because that back end shows all the debt plus the new property. And that ratio is kind of what determines how you qualify and what you need to qualify, because they're both different. So one's a little bit more risky than the other. So you are correct. It goes off of the income from the property, and we want to see with the one we can go back end at 75, and the other one we can go up to 100%. And with that being said, it has to do with the income from the property, and that's how we determine that.
Okay. So you kind of got into a little bit, but yeah. So what would be like the actual eligibility requirements for a DSCR loan, since we kind of like touched a little bit into it already?
Okay.
Yeah.
Well, I can kind of go over a little bit on both. With a back end ratio of 100% or 1.0, obviously it's investment properties only. If you're looking to move into that property as a primary, you have to have be generating income from the property. So it would have to be at least a 2 to 4 unit. So you can live in one, but then you'd have to be getting enough rental income from the other to qualify.
Gotcha.
Your max loan amount, $2 million. It's purchase rate, term, and cash out refinances. And again, this is back on the 100% back end. The minimum FICO is 660, and your max LTV. What's that?
It's very flexible, right?
Yeah, 660 that's pretty good, I feel like.
Yeah.
And actually, your max LTV is 70%, so it would be 30%. You would be required to come up with 30% down, not the 25. So I misspoke earlier. So it is a manual underwrite. So, every underwriter is different. They're going to want to, these may be our basic guidelines, but as soon as that underwriter gets it, every underwriter is going to want to see different things.
And also, just to point it out, those guidelines can differ from bank to bank.
Yes.
I know we're kind of going with what you know, but as we mentioned, everything today is going to be a little more like a general information, because this can vary so much from bank to bank. So Kelly's going to be sharing with us what she knows from Fairway at this point. But just don't take that to heart, because other banks might have different criteria. It might be higher, it might be lower. So just keep that in mind.
So with that being said, our other investor can look at a back end of 75.
Okay.
Same thing with investments. Max loan amount's $2.5 million. Your minimum FICO is 620.
Oh,
so okay. that lower back end ratio, you can go a little lower with your credit score. Max LTV is 20% or 80%, so 20% down is a required down payment.
A little more easier going.
And manual underwrite again, which is it is going to be a manual underwrite for all of these.
Yeah.
And
because it's such a unique type of loan, so it's not like something that can be just run through the automated underwriting, right?
Correct. So, and they're going to want to see bank statements. They're going to want to see, some underwriters might want to see a history of getting rental income.
Yeah.
Some might not. Some they may only want to use what they're getting from this. So a lot of new home buyers, they try to do this stuff too to make money to live in their own home.
Yeah.
So they would have to. So if that's the case, they would have to be making enough money on the rental side to cover both their primary and the rental side.
Correct. Yeah.
So.
And I think you brought something interesting too, that if someone is doing this type of loan for the first time, they may be required to bring in a larger down payment. Maybe they might be on the 30%, down payment, 70% LTV. But once they start adding properties to that loan, which you can, like as you move forward, you can start adding more and more properties to your portfolio. It becomes easier and easier to approve, and then your requirements actually get more and more lenient for that borrower, right? Isn't that correct?
Yes.
Yeah. So
yes.
It becomes easier for someone investing to purchase properties. They might have to put a bigger investment on the first one, but then after the second, third, fourth, it just becomes more and more easier and easier for them to approve to purchase a new property in that because they're going to have the history of the rentals coming in, and they see that you're profiting, you see you're doing great. So it would be more easy. It would be easier for you to approve it in the underwriting.
Mm-hmm. Yep.
Yeah. Okay, so let's go to the next one. So what factors do lenders consider when analyzing the cash flow potential of a property for a DSCR loan?
Okay, so this can be kind of broad. So I am going to go over the basics of what we have in our guidelines. So lenders usually limit the loan amount to maintain with the DSCR ratio. Hold on, let me make sure I'm looking at the right thing here. So
you're talking about the cash flow analysis, right?
Yes. Yeah. So basically in the loan term, so the loan terms are what goes into consideration. Your interest rate, your repayment period, your amortization schedule, and a lot of other things come into factor, such as the property value, the location, borrower's creditworthiness. There's a lot of different things that can go into play when it comes to the collateral. And am I answering your question?
I think you're talking more about the loan application, right? Process. When it comes to the cash flow, how you're analyzing the cash flow, is that more looking into the income potential and the operating expenses?
Oh, I see. I do apologize. So I'm sorry.
Or vacancies that property can maybe.
I should have numbered these.
Right.
Yes. So with the cash flow, so we usually assess the property's cash flow potential by analyzing the historical and projected income and expenses of the property. And there's a lot of things that come into play with that. It's your rental income, your operating expenses. They're going to be different for every property.
Yes. Yeah. And it's based on location, right? So market trends, if a location has a tendency to have more vacancy, they may associate a certain percentage to that property based on that location. So that's why, again, we're talking very general, but every property will have, like, you can be the same person with the same property purchase price, same scenario, same cash flow-ish, but that property based on the location and what the market is telling the bank and what the vacancy potential could be, that can change that approval amount or not. So it is based on the location. There's a lot of factors that play into the cash flow, analyzing the cash flow.
Yes, because they want to make sure that there's potential for more growth in that area. Now, right now, rent has gone up quite a bit. So I guess that can be a plus and minus for some people, because not everybody can afford rent going up.
Yeah. But people still need houses, right? So
yeah,
it's a tough situation, because I feel like the people still need a place to live. They're either buying or renting, depending on their situation, and the housing market just keeps going up. And there's a little bit of security in that sense. So for people trying to invest now, it's great. And real estate, the beauty of it is that if it ever crashes, just don't sell it. Just hold on to it, because you're not going to lose money if you hold on to it, right? I feel like that's something to keep in mind for investing purposes. If you buy it right the first time, there's very little that can happen unless the house burns down.
Right.
Unless you lose the asset completely, there's very little.
And let's hope you had good insurance.
I know, have good insurance. There you go. That's it, even in place. There you go. Not even burning down. It's a bad thing. It's just a headache, but it's not that bad. But yeah, so there's a lot that goes into analyzing that cash flow. So going into the next one then, what are the typical minimum DSCR requirements, which I think we kind of touched base on that when you're talking about the LTV, right? So it varies based on the broker. I'm going to finish the question so people know what I'm asking. So what are typical minimum DSCR requirements set by lenders, and how does a higher DSCR benefit borrowers? So you were talking about like, having different brokers have different requirements. And we mentioned that the first time buyers may have to pay a bigger down payment, but once they start buying more, they benefit from the lower down payments or requirements. And I think we're pretty much already answered this question, but do you want to add anything to it?
Not really. I mean, like you said, it just kind of balances. So the higher back end ratio, the more you have to put down on the property because there's more risk. That's the best word I can use. It's more risk when you're when they're looking at that high back end. So the lower that back end ratio for the DSCR loan, the more lenient they'll be with how much money you have to bring down, your credit score, and what they need to see in assets.
And that's why we say the more properties you add, the better it gets, because your debt to income ratio, as you have more properties netting more income, that goes higher, and then your debt is the same, or it goes up with your purchases, of course, but your income should be definitely higher, and otherwise you're not doing something right. So they become more flexible, and you have better advantages to add more properties in the future. So it gets cheaper to buy new houses as you buy them more and more. So that's why the richer get richer. Right. So buy your first home, and then the rest is, just a game. Okay, so the next question. How does the property itself serve as a collateral in the DSCR loan, and what impact does it have on the long term? So now we're in the collateral.
Correct.
Yeah.
So I think I said this earlier by accident. And I do apologize because
they kind of all merge together. So
they do, but these are new to me, and I haven't done one of these yet. So
it's a very unique type of loan.
Yeah, until I do one, it's not embedded in my brain just yet.
So if anybody's interested, Kelly's looking for a tryout.
Yes.
Someone to get one done.
Anybody who's looking to do this for, investments, this is a good product if you're not showing a lot of income, if you're self-employed and you're looking to do this. So this is a good product for that, because we're basing it off the income that you're getting from the property. Yeah. For the most part. So with the DSCR loan, the property itself serves as the collateral of the loan, obviously, because you're purchasing the property and we're using whatever income you're getting from that property, whether it's rental or however else you're getting it. Yeah. And again, we usually limit the amount to maintain certain DSCR ratios, but we want to ensure that the income is where it needs to be to have enough cash flow for the payments. Yes. So that's the biggest thing, is making sure that there's enough cash flow to make sure that we are at the ratios where we need to be. Yeah. So I think, the property itself is the collateral. Which goes along with the loan terms. Pretty much what we've gone over already. Yeah.
That's what they're using it for, the loan itself approval. So
correct. But like what we just said with the cash flow, that kind of goes into play with using it as a collateral. We want to make sure it's in the right property where there's no vacancies. Like we want to. So
there's always going to be vacancies, but some areas may have better, market numbers to show, less percentage of vacancies throughout the year. And that's something we all should be taking into account when you're looking into an investment property. Research the area first, because the property it's a great property, it's renting, great. But what are the numbers, right? Yeah. What are the common vacancies in the area? Is there the type of tenant? oh, you might have to take over, the type of tenants you're renting it to. So there's a lot of things that go into it.
There are, and that's, if you're thinking about doing one of these loans, it's definitely good to do your homework. And if you need help with doing your homework, like reach out to us. You know, we have resources that can help you figure that out.
That's
So
right.
yeah, it's definitely something you need to do your homework on for sure.
And again, you might require a little bit of money up front to get started. So you do have to prepare yourself to get this into this type of financing. But again, it doesn't take into account your personal income. It takes into account that property's potential cash flow and some other factors. And it may allow you to get into the investing, real estate investing world without having to worry about your own finances per se. So there's a good opportunity there. Okay, so next question. What are the key steps involved in the loan application process for a DSCR loan, and what documents are typically required? So I think you kind of got into that, but yeah, so that's the application, the loan application portion.
Well, since I haven't done one of these yet, I don't know all the steps, but obviously
they're very comprehensive as far as the things that they're looking at, right?
Yeah, they want to look at cash flow, so they're going to want to see bank statements. If you've rented before, maybe they want to see rental income that you've had.
So financial statements, rent rolls.
Financial statements, they'll definitely want to see returns,
Yeah.
To see what income has been derived from, previous businesses. But as far as this, I mean, there's a lot of things that can be used, like an appraisal can be used for rental income. It's a certain type of appraisal that we would have done to see what kind of rental income that they could obtain from buying that house.
And also, if you already own properties, I know they would do appraisals or request appraisals for the properties you currently own to see if they have grown in value too, because they may have the number that you used for the purchase at the time. But if those properties were not being valued, that also plays a role into your loan application, because it might increase your debt to income ratio, because maybe the value of that property went up and now you find yourself in a better spot if you needed to refinance, borrow against it. There's so many things you can do with this later on. So that's why they do a pretty comprehensive application for this one.
And in bank statements too, they would want to see, income coming in the bank statements that, income can come in any way. We would look at your tax returns, but they would also want to see it in your statements as well. We do have a bank statement program, but that's completely separate, where they just look at your bank statements and nothing else. But this would involve looking at your bank statements, seeing the cash flow coming in, profit and loss, that kind of thing.
Yeah. It's a little more in depth in the bank statements, I believe, right? Because we can maybe even mention about the bank statements in a different episode, but that one is more, it's ideal for people that maybe work for themselves, don't have a W-2 pay stub coming in, but they do have money coming in, and then the only way for them to, or even like waitresses, right? Like that have tips that they deposit cash in their bank, that could be used for that too, because they don't have a pay stub, or the pay stub is not sufficient to qualify them for mortgage. So they may use the bank statement as a way to prove, hey, I do make this much money. And then they use the average of 2 years or bank statement. And then they can determine the actual income for that person, even without the pay stub. So there's different programs. I mean, there's so much in finance. This is just one little, speck of dust in the realm of finance, but there's a lot of options out there, and just talking to Kelly, especially because I'm not in that realm. I know a little bit.
You know it better than me, so
because
I do one.
work with the buyer, maybe that was doing it, but the ins and outs of it has to be with the lender. So, and I'm pretty sure, even if you don't know, you'll be able to find the right answer for them.
We would figure. Yes, I would figure it out. I would know where to go to get the answer.
Exactly. You have a whole team behind you, so that's a good thing. But yeah, if anybody has questions on that, there's a lot out there that's available to you. Alrighty, so next question. What are some potential risks associated with DSCR loans, and how can borrowers mitigate them?
So I would say one of the biggest risks is, how do I want to say this? being able to get the rental.
The market itself could be a big risk.
Yes,
right? Like
that's
fluctuation of rental income potential.
Being able to get somebody to rent the property
at not getting
the rent that you need to keep the property going.
Yeah.
So, whenever you have a rental, the norm is whatever your rent amount is, we use 75% of that, because that 30% is to cover utilities and all the other stuff.
Yep.
So your goal is always to get renters. And right now in this market, it's a little bit tough.
Too hard. Yeah.
It's tough because a lot of people are increasing rent. Yeah. But so, people want to buy because rent's so high. So, that's your risk.
I have to rent. So I feel like right now owning property is good because there's people lining up to get inside rentals, especially if you have a good location. Again, that's why location is so important. But that's why, having a good location, having a good property. But going back to the risk, I mean, we mentioned the fire. That's a risk, right? Yes. It's your whole collateral right there. If it's something like that's what was to happen, let's not even be that dramatic. Not a fire, but maybe like a pipe burst, and now you have to vacate that person from the property, and it won't be fine. The repairs won't be done in 6 weeks. So now you're a month and a half without a tenant, and who knows how much after to get a tenant in there. So there's so many things that can happen, and you have to be aware of that, be prepared, and always have a little percentage, that you save every month to mitigate those type of incidents that can happen. On top of many others, I'm guessing, like even in tax side of things too, there's risks there if you don't file things correctly with your accountant. You can struggle there in that sense too. There's some risks involved there. So just be aware of everything and, prepare and plan ahead so you don't struggle with them when they happen.
Yes, because when you're the property manager, the whole property is your responsibility. So
you own it. It's your duty there. For sure. Yes.
So,
and we mentioned tax. So the next question, are there a specific tax advantage associated with a DSCR loan in commercial real estate financing? And we know there are, right?
There definitely are. I can't particularly tell you the only one I know offhand is using it as any interest that you pay, you can claim that on your taxes. But with DSCR loans, there are other things that you can do when you do your taxes to get benefits, to reap the benefits from it. I'm not an accountant, so I cannot say what those benefits are, but I know.
I'm going to emphasize this again. We're not accountants, guys.
Yes.
We are not. We're not giving you accounting or tax advice here. We're not. We're just letting you know that there are advantages. And then to name a few, and Kelly already mentioned, you have your regular real estate taxes that you can claim in there. You can do depreciation because now you own a collateral, a whole home. So you can actually claim depreciation every year. There's interest deductions because now you have a rental property and there's so much you can benefit from rentals. Operating expenses advantages as well for tax purposes. And you can use it for 1031 exchange. So if you don't know what those things are, I'm not going to explain them to you. Do your research, talk to your accountant. But there are tons of benefits of using this type of financing and purchasing property for rental purposes. So keep that in mind. Do your research, talk to the specialists from the area. I can help you find them. Kelly can help you finance them. Yep. And then you have to talk to your accountant to figure it out the tax side.
Yep. Yeah. And I know lots of accountants, so
we can recommend good people for you guys. But
yes,
we have an insurance person, we have a title company person, we have a person for everything. But just come to us and we'll guide you the right way. But we are not going to give you advice that we're not allowed to. Just put you in the right direction with the right people. That's it.
Absolutely.
And I think that's it. I didn't see any questions coming in live. So if you guys do have questions and you may be watching this on a recorded version, or maybe you're listening to us on the podcast, just message us directly. Our information is on the screen. If you're listening to it, just go to our website because I know there's a link there on your podcast that you can access. So just reach out to us directly in there or any of our social medias as well. And I think that's it for it, right? Do you want to add anything else for closing?
I don't think so. Just to say it is a good product if you're looking to buy an investment property.
Yeah.
I mean, really, that's all I think I have to say.
Yeah.
The details always, everybody's story is different, and the details come with each different client.
Property. Yeah.
That's different. That's looking to do this, but it is a very good product for somebody that's looking to buy an investment property and they're looking to use that income from the property.
Yeah.
So
yeah. It really is. It really is. Alrighty, so thank you so much, guys, for listening and watching us today. We'll be back next week with more good content. We don't know yet what we're talking about, but we'll let you know.
We'll figure it out.
We'll figure it out. But always with good stuff. So stay tuned, and we'll talk to you guys next week. See ya.
Yep. Bye, everybody.
Bye-bye.